Welcome back to the Educated Homebuyer Live. We appreciate you being here. Over the last week, we've had a lot of talk from the Fed with regards to expectations on rate hikes coming in December and the market as we head into 2024. Today, we got pending home sales. We've seen the 10-year move all over the place. And more importantly, Josh is back with us today. We got the audio fixed, almost coming up to the wire here. We had it fixed a couple of days ago, and then we had problems, and now we're back. So Josh, welcome back to the show.
I thought I was getting aced out. I thought you just didn't have the heart to tell me I was out. So you said, we'll just have technical difficulties every week and he'll get tired of showing up.
That's fantastic. And on top of that, we actually have another real estate expert from the Las Vegas market joining us here in a couple of minutes too. Also a YouTuber, Andrew Finney, who is going to jump in and chat with us live. So Josh, let's talk about the things that I started the show with. I think the big topic for a lot of people is interest rates, what's happening with rates at the moment, sitting near 2-month lows. And today we saw a huge rally on the 10-year after Jay Powell came out and kind of, gave us some not really positive news, but didn't really upset the market, which was probably the most important thing.
Well, literally what we saw leading up to the meeting today is the market sold off. We were probably an eighth worse in interest rates this morning because people were afraid of what he might say.
I was afraid of what he might say.
We all were. So the markets was super defensive. Rates were a little bit worse this morning. And we went from being off 0.1% to about 0.25% better by the end of the day. So a 0.3% swing in interest rates just today. Now, lenders are a little bit slow to adapt and react. That's where mortgage-backed securities are trading. So by tomorrow, as long as we don't give it back in the morning, we should see that. But Jeb, I'll throw this up here in simple terms. This, as you can see, this green candle says it's the best lowest we've been since October 3rd. But more importantly, this green line and this red line here gives us a range of what we've been in. And you can see we broke out to the bottom of that range this morning. Now you can see we did that in October also. And then
is this a daily chart, Josh? Or are we each one of those a day?
It's a daily chart over the last 3 months. So we have to see some follow through, but it could lead to more improvement. What we also saw this morning, initially there was some improvement off of the ADP employment report. ADP is kind of a second tier report just because it's not always the most accurate. But it can give us a heads up of what's going to come when we get the monthly employment report on Friday. So they were expecting 200,000 jobs created per the ADP report. It was 120,000. So it's still positive, still jobs being created, a net gain in jobs, but not as many as were expected. And if we look at the last few months, that's also what we've been seeing in the BLS report, in that jobs are being created, just not quite as many as have been expected, and it's slowing down. We're seeing less open jobs. So it's an important thing that the Fed is looking at. Fed's looking at CPI, more importantly, PCE. They're looking at employment figures. They want to see a higher unemployment rate, as crazy as that sounds, because that is one of the additional things that will lead to lower inflation. So where we're at right now, it certainly looks like things are continuing to trend in the direction of better interest rates. So don't take that as to say that, hey, rates are going to be back down to 3% anytime soon. But based off of what we're seeing, moderating inflation, moderating employment, and the Fed indicating today, what we've thought, Jeb, 2 weeks ago, it must have been 3 weeks ago, because I was actually here then. You had talked about what was the odds of a 75% chance of a 50 basis point hike in December. And that's really looking like what's going to happen. He sort of reinforced that today. Now we have the blackout period. None of the Fed voting members or any of the Fed members can talk between now and the report. So really, it should be fairly quiet between now and then. I don't expect a big movement one way or the other, but we've gone through how it's pretty possible to reverse engineer the CPI figures. We should see another moderation in inflation per CPI. That's the big one the market is traded off of. So that's December 13th. The Fed meets the next day, December 14th. They'll have prepared marks. They'll have a press release. So again, I'm not sitting here saying rates are going to drop 0.5% or 1%, but they should moderate through the end of the year here.
Yeah. And so with that said, Josh, we're sitting somewhere in the mid sixes at the moment on a 30-year fix, most well-qualified buyers, or is it lower than that?
Better than that. So
Okay.
let's kind of transition to that. Standard balance loan which is now a higher amount. We got the increase yesterday, goes
And
into effect January 1,
that.
but everyone's jumping the gun on that. So 726,200. So standard balance loans are sitting, 0 points right in at 5.99. So plus or minus 6%. The high balance loans still carry a premium because they added a 1 point LLPA. So you're probably talking, close to 0.5% higher if you're looking at a high balance loan. But it's a lot better than it was. And that tells you that our FHA and VA is in the mid to high fives from that end, depending on whether it's standard balance or high balance. So definitely much better than we were 6 or 8 weeks ago.
Yeah, and with that, we talked about. I mean, Josh kind of mentioned it there with the FHFA raising the loan limit, and I'm sure you've seen it everywhere if you've been watching YouTube or you get any emails from lenders or what have you. But high balance is now what, $1,089,000 here locally, Josh, for one unit, so up quite a bit year over year, and so that can help some people qualify, and we're likely going to see more and more people taking advantage of that if the market continues doing what it's doing at the moment. Again, we're not in that time of year when you see a lot of activity to start with because it's the holidays. And you could reference last year and say, yeah, year over year, we're down. Yeah, year over year. Last year, it was crazy. The last 2 years were crazy this time of year, which isn't normal. And that's one of the reasons that we saw the pending home sales again come in for the 5th straight month with regards to a decline. I think it came in at 4.6%. And these are from October pending home sales. So we're still a month lagging in that information or that data rather. So the next one you're going to get, it's going to come out at the end of December. And guess what? It's going to be the 6th month. And then January is going to report December. It's going to be the 7th month. And guys, it's no surprise. You're hearing it here. It's going to continue declining. It's just that time of year when you start to see that. So that's really the big focal point for this week. I mean, Josh kind of mentioned it. Not a lot's going to transpire in between now and when CPI comes out, unless something crazy happens with the job market on Friday, where they produce way more jobs than is anticipated. But based on the ADP report that Josh mentioned earlier, not likely to happen there. So what else? Anything that we want to add here before we go ahead?
Yeah, we had a couple of housing reports yesterday. FHFA was up 0.1%. Home prices month over month for September was up 0.1%, and year over year was up 11%. We had Case-Shiller. So Case-Shiller is sort of the gold standard for numbers. It includes cash purchases, jumbo loans, things that are not counted in the FHFA figures. FHFA is just homes that are sold and covered by loans that are sold to Fannie and Freddie. So within that, they were down 1% month over month and up about 10.6% year over year. So month over month, definitely moderating, flattening, down if you're looking at certain numbers that include the higher price points. Always important to point out those are nationwide numbers. Nationwide numbers are irrelevant. The only thing that matters is your neighborhood. If homes are down 5% in your neighborhood, you don't really care that they're flat nationwide, or if they're up 2% in your neighborhood, doesn't really help that another market is down 5%. But the numbers show a much smaller moderation than what you would get the idea from the strange headlines in the media.
No, and again, I mean, it's what we've been talking about for God, feels like forever at this point. So, and if you're watching this, guys, and on YouTube, I'm not sure if you're aware, Andrew, who's going to be our guest here in just a moment, might not be aware, but this actually gets streamed to a podcast, The Educated Homebuyer, that we post every single week, at least twice a week, or typically 2 times a week. One, the episode that drops on a Tuesday is something, housing related, real estate related, first time home buyer ish related rather. It's called The Educated Homebuyer. We're guiding you through that process. This past week, we're talking about how to get a mortgage in 2023, really walking you through that process. And if you're, an expert at this, then, maybe refer it to a friend, somebody that's going through that process, and help get the word out there. And if you're not, take some time and listen to it. We appreciate that. But we actually take this episode and stream it there on Friday. So if you can't watch this whole thing, want to listen to it on audio, you can go there and download it. So With that said, Josh, we're going to bring in Mr. Andrew Finney. Andrew, welcome to the show.
Hello, Jeb. Thank you for having me. Josh,
Absolutely.
that was some great
Good.
information. Thank you.
Good to meet you, Andrew.
Good to meet you
It's
too.
actually Andrew and I's really our introductory meeting as well. I had reached out to him a couple of weeks ago. Been watching his YouTube channel for a long time and knew he was in the Las Vegas market. A lot of people keep reaching out to us saying, hey, talk about some different markets. And Las Vegas is one that's been in the headlines because it was one of those boom towns, you know, quote unquote, during the pandemic where a lot of people were kind of fleeing to. And they saw a huge amount of price growth. But over the last, probably 6 to 8 months, they've seen quite a bit of increase in inventory. So wanted to bring somebody in there that actually is doing business as a real estate agent, not just a talking head online, to have a conversation and say, what does that actually mean? Right? Because we can read the headlines and it looks like, oh God, Vegas is going to collapse and nobody's ever going to go there. And people don't want to live there anymore. But that's what we're going to bring on, or that's what we're going to chat a bit about. I'm going to start over. That's what we're going to hold on. That's what we're going to chat about tonight. There we go. So, Andrew, maybe take a second here, introduce yourself, YouTube channel, and then we can just chat a little bit.
Okay, sure. So Jeb, thank you so much. I've been tracking your YouTube channel for a minute too. So it's funny how YouTubers coalesce that way, especially with other practicing realtors, and I have a lot of respect for what you do and what you and Josh are doing on your live stream. So I really wanted to say thank you for that, and I appreciate the opportunity to be here. Number two, for anyone that doesn't know me, my name is Andrew Finney. I am a practicing realtor in Las Vegas, Nevada with King Realty Group. I've been here for about 9.5 years. I see you, Dina. Thank you so much for the shout out in the comments. I appreciate you. So, you know, other than that, I just try to serve and add value to however I can. So the opportunity to be here, I just feel blessed and thankful. So fire away and I'll give you what I got.
No, it's not even about firing away. You're not on the the stand here, if you will. There's no oath you have to take.
Well, you know, I got the fancy lights back there if you want me to switch around into studio format, and
it's up to you. I've seen your format before, your studio, so you can come across however you want. We just like the information. So maybe just talk to us a little bit about what's happening in the market right now. We know inventory's up. What does that actually mean for Vegas and surrounding markets for you at the moment?
I think because Vegas is a top 50 metro, what we've seen a lot is a massive slowdown since the peak in June. So June, July kind of marked that spot for most of us in the country. In Las Vegas, it was more of May, June where we hit our peak. We hit a peak price on average, according to InfoSparks, of about 436. And then the current median right now is already down to 405. Anybody that's watched my channel knows that my honest to God thought isn't a doom and gloom situation, but it is one of a correction situation that I think that prices need to come down 15 to 25% off the peak. I think that has a lot to do with affordability when you start looking at it. And I can touch on that a little bit more if you want.
Yeah,
but to put it in context, what I just said, if you look at the inventory at the peak in Vegas being around 436,000, and that's all the MLS. I mean, that's Las Vegas, that's North Vegas, that's Summerlin, that's Henderson, that's everything in Southern Nevada, right? Combined into that number. Then you go into the current median at 405. That is already a 7.11% drop in the market, right? So does that mean our Las Vegas market is headed towards like 2008 stuff? No, it's not. Most of our homeowners, if not all of our homeowners, are in extremely robust situations, as are most homeowners across the United States with very healthy equity positions. So we have a lot of health in our market. It's just more of a slowdown. And since we are one of the top 50 metros, I think there's a little bit of a correction needed for people to regain their confidence and step back in the market. As Josh was mentioning with the news today, with the higher conforming loan amounts, with some of the other action taking place with the Fed, then we'll see what the rates end up doing moving into 2023. But my guess is that they start coming down on average for most qualified buyers, not just your top tier credit, but your average credit, and then getting into the mid fives or so, then I think that we're going to have a buying season coming up in the not too distant future. And I just hope that inventory keeps pace to avoid accelerating home prices. We do need to moderate, in my humble opinion, back to an affordable level for most home buyers. Just my humble
No,
opinion.
no. And so who moves to Vegas, right? I mean, is it Californians? Is everybody from California going to Vegas? Is it just people that want to gamble? Clearly, I know that's not the case, but I think that's what a lot of people think, right? Is that, these are the only people moving to Vegas. So who is the demographic at the moment in your market?
So that's a really good question, and I love this question because a lot of people do make that assumption, like especially with Arizona and Vegas, that everybody from California moves here. Yeah, sure. We have a appreciable population of Californians that come here, maybe somewhere between like 27 and 30% annually, but that's not everything. We get a lot of people from out of state, and we have had a lot of people over the last 2 years with COVID come here as work from home folks. So we did see an influx of that, but we still have a lot of people here locally as more jobs are being spun up. You had Amazon come out here, you have Zappos that's out here, you have the Raider Stadium that came out here that provided a few jobs, construction jobs, a lot of new home construction. Our economy is much more than just a strip and hospitality. So we have people moving up inside of Vegas. We have first-time home buyers that have saved up and getting into the market during that period of time. And now it's just, I would say that our average buyer is coming from all over the place, to be honest with you. I have buyers that I've worked with from all over the place this year.
No, I thought Josh was going to add a little Stapleton in the back of your comment there to spice it up a little bit. No,
let's do it.
But the seasonality, you get seasonality in Vegas in your market, like we do here.
So
go ahead.
I'm sorry. Yeah, so I'm kind of laughing because I always think it's funny because seasonality here in Vegas, it'll drop down to maybe 33 tonight, and that'll be pretty much the coldest we ever get, kind of like California in certain parts, but depending on whether you're inland or on the coast. But we do get some seasonality. But the reason I think that's a joke is we are always trading property the same way as you guys are trading property. People in New Jersey are trading properties no matter the time of the year. And I think that's where there's a heck of an opportunity for a serious home seller and a serious home buyer to actually find the right deal, as opposed to being in competition with other sellers or other buyers. There is some seasonality. So yes, we do dip down total volume wise, the amount of sites being closed, but there's always a deal to be had if somebody wants it.
Yeah. Josh, jump in there.
Yeah, no, Andrew, you said something that was really important. Seasonality. So let's say you're in New Jersey, you're in Maine, and you're buried under 10 feet of snow. There are still homes that sell in December, January, February every year. If we go back and look to 2008, 2009, 2010, very low volumes relative to what we're used to, but there were millions of homes sold. The market doesn't stop. It does continue moving. It's different. And you as a buyer, as a seller, as an agent, as a lender, we have to use different strategies. But it is important to remember that regardless of the seasons, either in the temperature of the market or the temperature of the weather, there's still transactions being done.
Yes, sir.
Now, are there opportunities right now in your market, Andrew? Like are you seeing any real opportunities? Are you seeing sellers panic? Are you seeing concessions on the buyer side? And the reason I ask this is because I've seen some of the panic. With a seller I had here recently, I felt like he kind of panic sold the property when him and I had a conversation. And I've told this story online where I knew we could get more money out of the buyer. We received an offer, and then within 24 hours, within 2 or 3 hours, we had already countered them back or accepted their offer rather than countering them back. And I'd already had a conversation knowing that the buyer was willing to come up, but he just wanted out. He was ready to go. And for what reason, I don't know. But are you seeing more of that at the moment, or any of that rather? And if you are seeing opportunities, what is it on? Is it on model homes? Is it on, like when I say model home, like a turnkey home, or is it on new construction or properties that need work, that sort of thing?
It's a little bit across the board, to be honest with you. With new construction, it's one of the funniest things because, the new builders were cutting back buyer agent commissions and playing pretty nasty with some of us and not wanting to work with us just a year ago now, right? Yep. Now they're tossing out higher buyer agent commissions. They're tossing out every incentive that you can imagine to buyers. I've seen some builders saying, hey, our product is $700. We'll offer you one of the 5 following options, including rate buy downs, including incentives, including design studio credits, including taking $50,000 off the price. So you start looking at that percentage basis. It's like, wow, that's pretty huge. On the resale side, yes, I've worked with some clients especially in the July and early August timeframe, as people were starting to acclimate to the sharp increase into federal funds rate and panicking about what that might mean for the economy. I did see some people, as you did, that started panic selling and representing the buyers in those cases. I mean, one of those buyers got the house like 10% under market, whenever right now our list price to sales price ratio is still hovering around 100%.
Right.
So if a property is priced well, they're selling. They're taking much longer to sell. We have, depending on which submarkets you're in inside of Vegas, where we have anywhere between about 1.5 to 4 months of inventory. In the case of like North Las Vegas, probably the most extreme case is in certain areas in North Las Vegas, we're up to about 5.5 months of inventory. So definitively approaching stable territory in that market. But most of our markets in the Las Vegas area are still tilted, slight seller advantage. But I think that's definitely trending back around to buyer's advantage, depending on what happens with the rates. My honest fear is that people jump on the market, buy everything that's out there, and we're right back to square one that we were a year or 2 years ago, and not enough inventory. That's not fair to a lot of people, in my opinion, because people have to be able to afford the home. I've seen too many people cashing in 401ks and using money from families. And I'm sorry, before I'm a realtor, before I'm anything else, I'm just a person. And I just wanted to see good things happen for people.
No, I can respect that. I mean, I don't personally think that we're going to get back to the frenzy that we saw, unless we saw rates, maybe dip back up into the low fours or something like that. I think you may see it pick back up. But even then, I don't know that that's, I mean, I'd like to think it's not possible. I mean, hell, Josh and I were having this conversation a year ago, probably about this time, talking about expectations for 2022. And I said, Josh, I don't think the market in 2022 can do what it did in 2021. I mean, if it did that, that would be insane. I mean, we should actually go back and watch that, Josh, because I'm pretty sure it was a conversation, something like that. And then the first quarter of 2022, I was like, holy cow, like this is nuts. Well, and then all of a sudden, obviously, the Fed got serious and, stopped with quantitative easing and all of that stuff. And the market kind of put on the brakes. But the first quarter did more than most years, than most markets do in a couple of years with regards to appreciation and just how fast things were moving. So I'm with you. I hope that doesn't happen because what we've seen is we've seen people put like builders, right? We've talked about builders heading towards a recession, builders in an environment like we're in at the moment where, money is no longer cheap. There's some, thoughts about recession, whether you believe we're in one, headed for one, coming out of one, whatever your thoughts are. And there's some unknowns and builders don't want to be the same situation they were in 2006 and 2007. So a lot of these guys are probably just hanging out going, I'm not starting anything. I think there's like something like 2 million plus permits actually pulled on new construction housing that hasn't even started. And the reason it hasn't started is because of the situation that we're in. So you need more and more homes to be built. The numbers at the beginning of the year were somewhere between 4 and 6 million homes, shortage, and that we needed to build what, Josh, was it 500,000 additional homes per year for the next 10 years to even keep up with the current housing demand of people becoming prime buying age and so on, so on and so forth. And we're not even doing that. We're not even keeping up with the pace that we had previous years at this point. So some crazy talk.
You're right. I mean, we could get into that pretty deep on anyway around. We could be here burning midnight oil if you get me going on that stuff. I watch this stuff and I haven't cranked out as many videos as I used to. But with those ones that I do, I'm adding a lot of research to them.
No, so, it's always good information, guys. And if you're not watching Andrew, go check him out. I mean, it's not just Vegas. It's all around real estate. And I'll tell you, I don't watch a lot of these channels on Vegas, but there's a lot of, just like there are in every market, there's a lot of doom and gloom people out there just talking about the crash in Vegas and whatever, just to get views. And it's really backed by nothing more than headlines. There's no actual research done. There's no actual context behind any of that stuff. Now, Josh, you look like you were going to jump in there.
No, what I was going to say when you were talking about the first quarter of this year, we said in the fourth quarter of last year that if rates hit a certain point, it will put the brakes on the market. And then we watched that happen in the first quarter, and it didn't put the brakes on the market. It was like putting gas on the fire. And by the end of the first quarter, both you and I, Jeb, we threw our hands up like, I don't know. I don't know what's going to stop the market. And the answer was it just took time for those people who really wanted to get in, sort of squeezed in through the closing door, and things leveled off from that point. But I agree, the same thing that you had said, Jeb. Where are rates going to go? Absent massive Fed buying like we saw during COVID, they're not going back to 3%. So even at 4.5%, we're going to see a much more moderated market. Affordability looks far better at 4% than it does at 7%, where we were there just 4, 5, 6 weeks ago. So it's good, it's moderating, but we don't have a recipe. We can go through all the details. I don't see how we have a recipe for the crash that everyone would hope for, that if they're a renter, if they have a YouTube channel, they want to doom and gloom. I don't see a recipe for massive home price inflation. Even with moderation in rates, the affordability isn't there that we have enough people to go after every listing on the market. So it's gonna be an interesting couple of years. And the other thing that kind of struck me while Andrew was talking, we talk up here every week, wherever you are in the country, when it comes time for you to buy or sell a home, get a mortgage, make sure you're dealing with an expert. And it's kind of hard. It's a term that's thrown around too much, but you know it when you see it. So what did the Supreme Court say? It's hard to define pornography, but I know it when I see it. It's kind of the same way with an expert. Say, listen to Andrew talk. I've never met Andrew before tonight. I've never watched one of his videos, but he didn't have to search for these numbers. He knows, months of supply in different areas of the market, what prices were, what prices are, how that's impacting affordability. So if you're out there and you're in the market, you're talking to someone about buying or selling a home or getting a loan, if they can't answer your questions rather quickly with a solid level of data to back up, it's not just opinion, because I can tell you everyone in my business and everyone on the real estate side, they all have an opinion. No one's going to go, I don't know. But most times they're just going to spout, this is what I think is going to happen, or this is what happened 10 years ago. Make sure they have data to support what they're saying one way or the other. And that's what Andrew's brought for us tonight for the Vegas market.
No, good stuff. And a lot of them are just going to copy what they heard from the last guy. They're just going to, whatever they heard on YouTube or TikTok or whatever platform, they're just repeating a small verbiage of that without really understanding what they're talking about. So I want to go back real quick, Andrew, and ask the question a moment ago about property selling. We kind of mentioned new construction, but are, properties that are priced correctly, you said are still selling. We went through a time here in our market for the better part of 2 years where homes that were in inferior locations, that were inferior with regards to upgrades, condition of the property, were still selling at a premium relative to the homes in the neighborhood that were already fixed up. So the home in the neighborhood that was, turnkey, picture perfect model home, not meaning new construction, just model home in general, the inferior property was more or less selling at the same price of that home because of the lack of inventory and just the craziness in the market. But what we've seen since then is the home that's inferior in location, inferior in condition. A lot of those homes aren't priced in an inferior way. They're still kind of trying to price it, towards the upper end of the market. And those homes are sitting a little bit longer, not getting the action. Whereas the homes that are nice, that are priced correctly in my market, a lot of those homes are still getting multiple offers, are selling relatively quickly. In some cases within a couple of days. Are you seeing something similar in your market, or is it pretty standard across the board with regards to what's getting, bid up and what have you?
We're really not seeing a whole lot of multiple bids compared to what we were just even earlier this year. With, as you were describing them, I love your phraseology there, inferior condition and inferior locations. I love that.
Garbage is what we were really trying to say, but we were being nice.
We could say a lot of things, but I love your preacher speak. I thought it was amusing. So with that said, those properties are definitely struggling to sell unless they are in a position that they're ready to slash and burn the price. Most of the properties that are turnkey move-in ready, they need to be not only well priced but competitively priced. As I've been sharing with some recent sellers, we need to price in what we think might happen in the market based upon where we are right now and based upon trying to position ourselves against the competition. Like a moment ago, I mentioned North Vegas. They have had an increase of nearly 300% inventory year over year. You asked me about year over year numbers, and the question you sent is like 300%. I was like, holy crap, 300% is so substantial, right? Well, no wonder why it's taking 55 to 70 days to sell a property on average. But a year ago, it would have taken like 3.
Right.
And it would have been, to your point, anything. So we're not seeing as many multiple bids. We are seeing the nicer properties sell quicker than others, as I saw whenever I got into real estate in late 2013 after my active duty years. That was a market I walked into, and you gentlemen have been around for a long time. That was quite the interesting market to be walking into. But any market that I've seen thus far, anything that's nice, anything that's priced right, anything that is is ready to go is going to sell. And if the property, the lesser inferior condition that it's in, the lesser the price the structure needs to be, or the more credits the seller needs to be prepared to offer.
No, good
Well,
stuff.
Hey, along those lines. So I was on a call last night. We had a realtor from Chicago, lender from the Maryland, DC, Virginia market, another one from Tennessee. And we had this exact conversation. What are you seeing in your market? And all of us were saying, I'm not seeing a big decrease in prices, but the decrease, the difference between last year, a home would get listed at X and it was going to sell at X plus 2, 5, 10%. You're going to have no contingencies. You better have really good financing, be really qualified to get it. And now it's some type of concession. Seller paying closing costs, seller paying buy down, seller decreasing the price from what they're asking, because other than the perfect turnkey homes or homes in great school districts, great locations that are unique, there's more choices, there's more supply than there is demand for those homes. Is that consistent? I mean, Jeb, for you too, for what you're seeing here in Southern California, Andrew, what you're seeing in Vegas, would you say that is more of the big shift versus huge price reductions other than homes that were either overpriced or are horribly inferior? We are seeing those. I mean, there's some homes that comps would justify, or you could justify listing at X price, but you just look and you go, that house is so ugly that there's 3 other homes in that neighborhood. Why would someone buy that absent a huge discount? And I see that sadly all the time. I have agents talk to me, can you get me a flyer showing what a 2-1 buy down would look like, or seller concessions? So maybe just both of you comment on, from a seller's perspective, if you're talking to someone about listing their house, how important is pricing that thing right? And what role are the concessions playing? Because I see realtors coming to me and saying, show me what we can do in terms of concessions or discounts. I'm like, bro, it's not going to fix the problem. That house is not up to par with the other homes that are available in that neighborhood.
No, I mean, I'll kind of go first. I mean, you know, Josh, we put a chart up here on the screen a couple of weeks ago from a local report that both of you and I, that we both subscribe to here in Orange County. And that report actually showed what happens when the home is priced correctly versus what happens when the seller has to reduce it, a couple of percent and even more. If it's priced really badly, it ends up selling for much less and takes way longer on the market to actually, to go into escrow. So it just showed you that by pricing it correctly from the start, you're more likely to get your price or pretty close to it. I think it was like 97 or 98% or something of the list price it would get. It might have been, but let's just say 98% to be fair here. And it would sell within, a week or 2 weeks versus, a 3 to 5% decrease in price. It ends up selling like 8% lower. And then when you have to lower it more than 5%, it ended up selling for like 15% lower. And took 2 months to do it. So I think that is the conversation at the moment. And we've talked about it. I mean, I will tell you, be completely transparent with you. Like, this is not a busy time of year for me. It has never been a busy time of year for me. Last 2 years, it was a busy time of year. This year, it's not, right? I mean, I'm kind of back to the norm. And this year it's somewhat welcome just because of the craziness that we've been through. And it's more of I've always used December as a planning month for the rest of the year. It's time to take more time off to work on a business plan. And that's what I'm doing at the moment, is focusing on, okay, what is 2023 going to look like? What do I need to focus on versus last year closing 4 or 5 escrows in the month of December? That wasn't normal for me. But I think if you want to sell in this environment, you've got to have that difficult conversation up front with the seller. And a lot of agents out there at the moment haven't had the experience in having difficult conversations. I've referenced it before. There was that one little meme floating around through Remax where I guess their CEO or somebody had mentioned it. Like 91% of agents in this market haven't had to have a difficult conversation. They haven't had to ask for a price reduction. In a market where I think days on the market were more than like 45 days or something like that. And so it just shows you you're in a professionals market. Josh, we talked about it at the beginning of the year that's what we were going to transition to. Now we're here. So, Andrew, thoughts?
I completely concur, sir.
Well, I wanted to say thank you for your service. You mentioned
Oh, well,
a
thank
moment
you.
ago. So thank you for that. And yeah, so, but anyway.
And
Andrew,
and on that note, I do want to validate what you and Josh are doing, by the way. I've played with it, you know, without getting into like my pause on YouTube or whatnot, but I would like to validate what you're doing back to whenever you were saying doom and gloom and how
Right.
much of that's out there. I just want to say thank you both for keeping true and staying true to sharing the good word and keeping the faith and helping your audience and helping as many people as that may find your content, and addition to obviously the people that you have the privilege to work with locally. So I just wanted to take a moment and validate that on both of you and say thank you and honor you for what you're doing.
No, that's awesome, man. I appreciate that. Sometimes it feels unrewarded, if you will. Feels like we're beating ourselves over the heads here. So it's always good to get positive feedback on it. One other question I wanted to ask you, Andrew,
Yes, sir.
and I completely lost track of what that is now. So I don't know.
Think on it for a second, Jeb, because
Yeah.
while you were talking, there was something that you said, just the importance of pricing right. What I would say, and an experts market for realtors and transitioning to that. The last 2 years, a bad realtor listing your home couldn't really hurt you because we're in an auction market. The demand outstripped supply. So put it in the market at any price that isn't grossly overpriced. And the price discovery is done by the market. Buyers will come through and tell you what that home is worth. We had you guys here watching the show saying, this is crazy. My house didn't appraise. I'm paying more than it's worth. The price discovery of an auction market tells you what the home is worth. If there's 10 buyers willing to pay X, that is what the value of the home is, not what someone can value it at. Now we're in a market where we don't have an auction. We don't have 10 people lining up. You have one person, and that value is determined by what the seller is willing to accept, what the buyer is willing to pay. And what Jeb just ran through for us is the importance of pricing right. If you price too high, you're going to discount more than you have to. If you price too low and you accept the first offer, like Jeb's condo listing, you might be leaving money on the table. It is very important to deal with. We talk about numbers never lie. Someone that can come show you all of the homes that have sold, all of the homes that are going to be competition for you, and honestly and accurately go through and compare that. So it's definitely much harder job for you guys now than it was the last couple of years.
Yeah, we actually have to know what we're talking about now, versus over the last couple. I can't tell you. I remember seeing these things and it drove me nuts. How many? And Andrew, if you were one of these people, I'm sorry. That put out every time they sold a house, record sale in the neighborhood. It was like, you did nothing. You didn't do anything. Like, you just put it on the market. It's not the marketing that you did that got the record sale. It's not some, the video that you did for the house. It's you put a sign in the yard and put it on the MLS. That's the reason you got the record sale. Now, you get a record sale today, send that out to the world, right? I mean, you did a good job. You did something excellent, but let's not make this something it's not, because anybody could have done it during that time. Now it's a little bit more difficult to do. But I remember the question, Andrew, and the question was, did you guys have a lot of the iBuyers, the online open door, the Zillows buying property in your market and or turning around and flipping it and or turning it into rentals? And if so, has that stopped, and what has that done to the market?
Yeah, so those critters I first started talking about on my YouTube channel, I think it was 2016, 2017, and I expressed grave concern, and I backed up a lot of different facts, facts, collateral analytics. I'd read some ran some reports nationwide in all the different markets they were focusing in. Anyways, to back that up, or to share briefly on what that was, is that the typical seller using an iBuyer platform would end up paying somewhere between 12 and 15% of the total value of their property, versus that of, let's say, a traditional agent between 6 and 8%, all things considered. It was horrific for the convenience of cash. That's number one. Number two, get back to your question. How are we seeing that in Vegas? Have we seen that in Vegas? Yes. Unfortunately, Vegas is like a melting pot of real estate across the United States. It's almost like whatever you can think of is in Vegas, not only from the Strip, but in terms of real estate, and also in terms of how many technology companies like, oh, well, what's a good trial market? Well, let's go to Vegas because they always have turnover. It's a transitory type city. Average homeowner duration, tenure is about 3 to 5 years. They turn over faster than the almost 11-year average nationwide, right? So what's next? Phoenix. So those are like the playpens for these tech companies. The impact that it was is that you increased you increased unfairly, in my opinion, the already overheated market for scarce inventory and drove up prices unrealistically higher than they needed to be had they not been a presence.
Right.
And I think it was earlier this year on my predictions video for this year, I had shared that last year we had seen something like 20% of all the market in the United States being consumed by iBuyers and REITs. And my concern is when you start looking at the impact of that, it's pretty gross. It's pretty nasty stuff, because now you got people out there trying to make buyers think it's the greatest thing to invest into a REIT, to put some money aside, to gain some money since you can't afford to buy. But what you're really doing is you're pricing yourself out to another cash investor. So what do we see them do? We see them typically try to flip out the property, or I haven't seen a lot of them try to rent it out. They're trying to cash it. And now with open doors sinking gracefully, if you will, which was only a matter of time. You know, people ask me, what do you think of the iBuyers? I said, they're going to go under. I said, they're backed by Wall Street. If they can't perform, their business model has failed right from the beginning, because they're not profitable based on their running the business. They're still not. So now they're liquidating inventory. Now, Zillow was the funnest of all of them, because Zillow was haircutting all their prices, even in an overheated market. So that one was pretty fun.
Now, so the real question is, Andrew, how accurate was your predictions video?
Pretty damn accurate. Yeah, I'm not lying. I mean,
I know. I'm being serious.
No,
because I mean, ours was, I don't know that our interest rate prediction was awful.
Mine was awful. That was what I was going to tell you. That I was way off.
Other than that, I just, I don't even remember what we were saying at the beginning of the year, other than probably a cool down in the second half. But yeah, I'm just curious to what you were thinking the market was going to do.
So I thought that the market would potentially start going into single-digit appreciation, if not going into full-blown depreciation. Whenever I shared that I think the market would come down 15 to 25% on the nationwide level off the peak, that's the key word, off the peak. It's not off of where we started the year. It's not off of 2019 or 2020 before COVID. It's off the peak. So the interest rate was the grossest one. I had shared with my lender. I was talking to him like you and Josh do. And I said, hey, what do you think about the rates? I'm going to make this video. He told me his thought. That's what I ended up using. But I told him, I said, I actually think rates will be somewhere between 5.5 and 6 by the end of the year. He said, you're smoking crack. And I said, I don't think so. And he said, what are you basing that off of? I said, I'm a human, and I base things off of home affordability. And I base things off of inflation, and I base things off of real pain. No, and I said, the conversation I'm having with clients, there's a lot of pain.
Well, you were about double the accuracy that Josh and I on the rate side.
Oh, but I didn't say that in the video is the problem. So that's why I can't claim it. I'm just telling you the backstory behind it.
No, good stuff. So Josh, anything you want to add before we dive into some questions here?
No, we have some really good questions and comments here tonight. So it should be an interesting conversation.
Andrew, do you want to stick around and answer some questions, or you want to dive out? It's up to you, buddy.
Let's go for it. I'm having a good time. You guys are awesome, and your audience is wonderful. So I'm happy to help.
All right. Well, if at any point you need to go, let us know, and we can go from there. But before we do that, I want to ask that quick favor: hit the thumbs up, subscribe to the channel. We already put the link below if you needed a referral, but it's also pinned in the comments of the video if you need a referral anywhere in the U.S. It'll get you in touch with Andrew, get you in touch with lender, just depending on what you're looking for. So, Josh, why don't you tee up a question there, since you're already in there checking them out?
Yeah, let's jump in. I wanted to kind of go through a piece of this here. We had several people jump in and having some things. So Patrick started the conversation saying, whoever refinanced between 2 and 4% made out well, especially if they had a HELOC around that same rate, made great moves. Don't see us getting back there again. Without getting too far into that, let's focus on the HELOC part of it. Ron's dad popped in and said, HELOCs are variable and go up after entry and be recalled anytime. HELOC is trash debt. So we got one person saying HELOCs are great. Anyone that got one did a great job. Another person pointing out some of the downsides of HELOCs. Patrick steps back in and says, you can actually lock a HELOC. Then we have, someone asking what are interest rates, and another one here just saying, hey, I got a PenFed fixed rate HELOC when it was 3%. The Federal Reserve with low rates deserves a credit. So lots of misconceptions here on both sides of it. You can fix the portion of your home equity line of credit that you've borrowed. So for any of you that don't know what it is, you own a home, you have a first mortgage, you like that rate, you want to take some cash out, you put a line of credit in place. That is always variable because you're going to borrow that money in the future. After you borrow it, you can fix it. if rates happen to be really low, and not with every lender, but most of them will. So you have a $100,000 HELOC, you borrowed $30,000, you can fix that portion. We were talking to everyone earlier in the year when people started saying, hey, rates are up. I got a 3% rate. Rates are 4%, 4.5%. I want a HELOC. I said, well, be very careful, because the HELOC right now is 3.25%, 3.5%. By the end of the year, it's going to be 6%, 7%, because we know the Fed is going to be hiking. The Fed does not directly impact your mortgage rates, but what they do impact is the prime rate, which all HELOCs are tied to. So everyone's kind of right here. You can fix a portion of it, but only if you already borrowed it. If you're saying the benefit to me is I have a safety net here of having a home equity line of credit, it's 100% correct that it can be shut down and recalled at any time. If values drop, the lender, or for any reason, the lender could just say, hey, we're not comfortable with this. We're shutting down your line. You didn't borrow against it. If you've borrowed against it, you can fix at whatever the current fixed rates are. And currently today, prime's at 7, going to 7.5. So anyone taking out a HELOC, not super beneficial unless you're borrowing a very small amount and you have a very big first. So just wanted to jump into that conversation and kind of give some context to HELOCs, the pros and cons. They're not evil. They're not great. They're neither. They are what they are.
No, good stuff. And Ivy has a question here, says, when will you have an expert from New York City? So I have a couple stipulations when it comes to experts for the most part. So I've done a Phoenix expert offline on the podcast just because he's a good friend and I know he's a smart dude and it's easy to have a conversation. The problem with video is that it's hard to find somebody that is it's not hard, but it's a little more challenging to find somebody that's knowledgeable, knows their market ins and out, and actually has somewhat of a personality and can chat on video. A lot of people freeze on video, don't want to be on video. So finding somebody that already has a YouTube presence is a lot better in my belief if they know what they're talking about, because it's an easy transition. Hey, you know your market, you're good on camera. Can I have you on my show? That's Andrew's a great fit for that. New York, I don't know anyone, right? A lot of these markets, I don't know anyone in those markets that, you know, is great on camera and knows their stuff. And a lot of the reason is because I don't search these areas for real estate content. I don't watch a lot of real estate content on YouTube. Crazy enough, right? I mean, I read a lot and Josh reads a lot and we share a lot of information and I chat with some other people and chat with experts I know in other markets, but I rarely watch YouTube. So if you know somebody in a market that's good on video, that seems like they know what they're talking about, let me know in the comments. Like, I'm happy to reach out to these people and get them online. And that goes for any state. So just keep that in mind, guys.
I was going to say, were you asking for nominations? It sounded like it. So official request for nominations.
Yes. Send that to me. I saw, let's see here. I'm going to ask this question to Andrew for one. How many months is considered good inventory? So historically speaking, I think the consensus, if you will, has always been 6 months is like kind of the defining point. Anything less than 6 months is a buyer's market or a seller's market. Anything more than 6 months is a buyer's market. Do you still feel like that today, Andrew? Or do you feel like the number of months is less important than some of the stuff happening in the market?
Before you answer, Andrew, let me modify, because I like the question. The questioner is asking what is considered good inventory. Jeb, you just defined balanced inventory, equally balanced between buyers and sellers.
Correct.
So good depends on whether you're a buyer or a seller and what you want for the long-term perspective of the market. So comment on all of that, Andrew.
Well, great. So I had both of the sides coming in. So thanks, Jeb, and thanks, Josh. So I would have been inclined, in all fairness, Josh, I would have been inclined to answer that a lot like Jeb did, thinking, okay, well, what's fair? Well, fair is a balanced market. That's where you can normally see both sellers and buyers getting a pretty good shake. But I like your point of view on it because it does add a different texture and a different depth to it. What's a good market? Well, right now, I would say that we're probably right there on the split hair based upon what we're seeing in the market. But if it continues to increase the amount of inventory, then we're going to start tipping over to the buyer's market. It's going to start making it a better time to buy. Now, if you gentlemen are right about what rates might do going into 2023, where they might level off and moderate, right? That's going to make it a more advantageous time to purchase, because if rates do get into the between 5 and 6, or even potentially a little bit less than that, or hover around that, then that's in line where I think the market will be in the 3 to 4 year horizon, and where we see a new rate, and that's a new average to try to keep pricing and everything in check. Now, that being said, I think that would be an excellent time to get into the market and buy. And I still think it'd be an excellent time to sell. And here's why. You're like, oh, you're a typical realtor, a good time to buy, a good time to sell. Well, it depends on your reason. Number one, it depends on the reason. Always got to be in touch with your motivation about why you're selling or why you're buying, right? But if you're selling and you're trying to get the most out of your property, this is a market to do it. Because if the market continues to do what I think it's going to do personally, then what's going to happen is you're not going to be able to see that price again for probably at least another 18 to 24 months, if then. So that puts it in context as far as motivation to sell. If you're looking to buy, why wait when you can get what you want today and chance the rate may be going up? You can always refinance to a lower rate. Maybe the stupidest thing I've ever heard anybody ever say is date the rate or marry the house. No, because there's implications to all that stuff. I think that what's best is that people gather all the information like they're doing and listening to your podcast or watching your series, watching your videos, whatever have you, and gathering as much information as possible to make a well-informed, balanced decision that is right for them, for the reasons important to them, when the timing is right for them. Trying to time the market will time you right out of it.
No, I agree. And I'll follow up kind of with my thoughts on it. I think the 6 month kind of split, if you will, I don't feel like that's accurate at the moment. I feel like we're probably in a pretty close to a balanced market at the moment for a lot of markets out there with having less than 6 months inventory for the most part. Now, Logan Matashami, if you follow him at all, Housing Wires, expert, which Josh, by the way, I reached out to him and I forgot to have this conversation with you offline, but so I'll just have it here. And he said that he is, he's on retainer through Housing Wire. So if we want to have him on, we have to reach out to Housing Wire and get the okay. So that's a reminder that we need to do that. But nevertheless, he thinks that 4 months is kind of the new norm, if you will. And I think I agree with that, right? Because at the moment we're seeing more buyers and sellers conversate and deals are happening. But at the same time, I'm still seeing some deals sell at above asking with some multiple offers. So I feel like we're pretty close to a balance if we're not, there in some markets already. So yeah, that's my thoughts on it.
And Jeb, what I would say is it's nothing's going to be consistent over the next 10 years. So if we said 6 months was balanced or 4 months is balanced, we're never going to have that Goldilocks where it just sits in this perfect space where sellers can sell relatively easily and buyers can buy without having to overpay and bid prices up. So you just don't want it to go too far in one direction. You get back to 2008, 2009, when some areas had 18, 24, 36 months of inventory. It's way too far the other way. It actually scares buyers. It's too easy. Buyers are like, why would I buy? No one wants to buy these houses. We saw the last 2 years what a half month or 1 month of inventory looks like. Yeah, it's great if you're ready. You're ready to cash in your chips and head to Vegas, literally. But other than that person who doesn't have to go back out and buy, we talked about it, our sellers the last few years that were going to move up or move to another town. They're like, hey, this is awesome while I'm selling. This is uncomfortable when I have to become a buyer. So somewhere in that in between, maybe 3 months to 9 months and ebbs and flows over time makes it where it's never too uncomfortable for you, whichever side of the equation you're on.
No, good stuff. Here's a question for you, Andrew. I don't know the answer to this per se, because I don't use any of these websites for this, but it says, while searching for a home, I want my kids going to a great school district. What validity would you put on the school ratings in Zillow, Redfin, Realtor, et cetera? So I don't look at school rate. In fact, I don't even look at any of those websites. So I'm maybe a little out of touch there with regards to what the public's seeing. Here in California, what I'll say is that there's a website called greatschools.org. And that might be a nationwide website. I just know it works here in California, where if you type in zip code, actually property address, it'll tell you what schools your kids will go to, and it'll give a rating on those schools. And those ratings, I feel like, are pretty accurate. I'm not sure 100% what they're based on, some sort of testing scores, but I don't know if that translates into some of these other websites or not. Your thoughts?
Yes. So greatschools.org, to my knowledge, is nationwide. It is one of the links that I have suggested in times past in the home buyer videos and whatnot and stuff that I give the client. So whenever you look at that, I think that's one good spot. But I think if you want to balance it off and to be more specific to Jay Homeboy, Hi Jay, homeboy. I don't know. It sounds fun, so I'm trying to have fun. I mean, I can't.
They are a regular, so we get lots of good questions.
That's awesome. So if you were asking me my personal and professional observation of those different sites that you mentioned, I'd probably lean onto Redfin as having the more accurate data just based upon what I generally see coming out of Redfin versus Zillow and Realtor. I think Realtor's great, but I think Redfin is better. So I'd be more inclined to take face value, what I see on Redfin, then dial it back to what Jeb said, look at the greatschools.org or get with the Realtor and ask them what the actual link is to that school district. Like here it's Clark County School District, right? Why not go on there and look at the actual school ratings? I mean, that's the most accurate of them all.
No, good stuff. Good stuff. Here's one for you. What makes a good realtor, Andrew?
Oh, me. No.
That's always the right answer, but no,
That
in all reality, like if you're referring somebody, right? So
Yes.
it's a market you don't serve. You're making a referral to Huntington Beach. What are you looking for in an agent that you're going to refer to?
So that's a good question. I've made videos about this too. So generally what I would suggest is it depends whether you're a seasoned home buyer or a seasoned home seller. And I could touch on that if you want. But for now, if you want a blanket answer across the board, is you generally want an agent that sells a minimum of somewhere between 10 and 14 homes annually. So that you have an agent that's consistently in the market, that's up on the law changes, that are up on the form changes, that are up on the process and up on the tempo of the market. So that would be what you look for, number one. Number two is you want to actual Google your agent. You talk about date the rate, marry the house. Screw that. You want to date your agent through figuring out those reviews to see if they're the right fit for you, because you need to feel like you know them. You need to feel like you can like them. And you need to feel like you can trust them. It's one of the beauties about things like this and social media. You get the opportunity to put yourself out, and either someone likes you or they don't. If they don't like you, bounce off. If they love you, then hey, let's get in touch and let's do the thing. But when you're looking at it from a initial point of view, look at those online ratings, look at those reviews, go to Zillow, go to wherever those Google reviews, whatever. I got like over 155 stars out there. They're across the board, right? Look at them, read them, and see which ones click with you, because to my knowledge, an agent can't pay for those things. Those things are hard-earned, battle-won reviews that took a house closing of some nature to be able to get done. Those things are
You worked hard.
Those things, yes, you've worked hard, and I think they're worthwhile. But those are two of the main criteria that I look at. And the third one is just pick up the phone, maybe meet with them, maybe hop on a Zoom and get your own warm fuzzy. If you get a warm fuzzy with them and you're happy with them, roll on. But if you're not, then pop off and get a different one.
There
That's
you
why
go.
I look at it.
I like it. I like it. S. Smith, are you kin to me?
So that's what I was gonna say. It's not Landon, Walker, Nash, or Nikki. So which Smith did you pay
I don't know.
to say nice things
this looks
about
like this looks like a plant, but we're gonna go with it. The Josh and Jeb team are awesome. I look forward to information every week. So kinned or not kinned, I appreciate the comment. There we go. Let's see here. Marcelino has a lot of questions tonight. But this one says, if we feel a house is overpriced, is it unreasonable to offer 20% below the list? Thoughts on that, Andrew?
Of course, you would.
No, I'll answer it. I'll answer it.
No,
first.
I got you. I got you pretty quick on that.
Okay.
So it really depends. So to me, the first thing is that you want to run a comparative market analysis on the property. If that property is at fair market value, what are properties trading on average in that area within the last 30 to 45 days in specific, given the flux in the market? Depending on that answer will depend whether that is an unreasonable thing. That's the more logical approach to it. The technical approach to it would say, hey, a buyer can offer whatever they want for a property. But if you want that offer to get accepted, then you need to be realistic to the market, hence the comparative market analysis, hence what is the average list price to sales price ratio for that area. That's where I look at it. Now, they said if the house is overpriced, the only way to know that is running those comps.
Yep. Agreed. I agree 100% with what you said. I mean, the only thing I would say is you can do it, but it doesn't mean it's going to be accepted. It could be a complete waste of time. So
I was going to say the same.
Yeah.
I was going to say the same thing, Jeb. Let's say you have all the data in the world and everything says that house is worth 20% less than it was listed for. It doesn't matter if the seller's not reasonable and receptive and willing to hear that, which if they price 20% above market, they may not be.
No, good stuff.
Crap crazy. I call them crap crazies.
Comment from Christina Smallhorn. If you guys know her, follow her channel. Always good stuff. Great person, just great individual in general. So appreciate you being here, Christina. Always good to chat with. So let's see here. Yes, sir.
We had a nomination here. Ivy says, we have Ryan Serhant. I wish you could get him on. He's the best in New York City. Any chance you could get him on? And so my only thought was, maybe he's not on YouTube and he's trying to build a presence. And
No,
Jeb
I'm pretty sure he's on YouTube.
Well,
without really having to be.
he only has 1.28 million subscribers. So I'm not sure that our reach would really help him in facilitating his career goals. And furthermore, his ultra high end space, he's an expert in that ultra high end space.
But that's actually good to have on. I mean, we could chat with that. You know, it's worth reaching out. You never know who knows somebody.
Let's send him this video and the free publicity we've just given him, and maybe he'll want to jump on for 10 or 15 minutes.
Hit him up on his LinkedIn too. I've been trying to get his attention for a while too, whenever I was doing live streams. So it's worth a shot. That's the first person.
You never know who knows somebody. So it's all about reaching out. Like, so, you know, I mean, there's 177 people or something listening now. Who knows somebody that knows Ryan that can make it happen? So that's what we're asking for, guys.
He might be watching you right now and
he might
be later.
He might. You never know. Rich says, Josh, do I have to use the lender's appraiser or can I use my own?
So the appraiser independence requirements or AIR guidelines post housing crash says you as a buyer are never able to pick your lender. We as the lender, we don't directly pick it. So either as a company, we have to have a department that manages the appraisals that is firewalled. I just made my lights come on. That is firewalled from the originator, the salesperson, the processor, the team that's doing your loan, so that we don't get to have any direct say on who's going to do the appraisal. More commonly, we use a third-party appraisal management company. We place the order and they select who it's going to go with. So the answer is neither you nor your lender directly pick who is going to appraise your home.
All right. Good stuff there. Patrick says, can we discuss what squatting is and ways to avoid potential issues with tenants, lessees attending to take over vacant or long use properties? Thanks. So a squatter is basically somebody that's staying in a property without having the rights to be there, if you will. It could be a tenant that had a lease and is no longer, the lease isn't valid. They're not paying. They're not leaving the property. It could be somebody that found a vacant property because it was advertised online, broke in. Now they've set up camp there and the state of California says they have rights and you can't get them out. You think I'm joking? That's like, in all seriousness, that could happen. But how do you avoid it? The biggest way, I mean, I talk about this all the time, and there's no surefire way to avoid any of this stuff, quite frankly. But doing your research up front as a landlord, as an agent that's helping people rent property, making sure that you have somebody that has solid credit, calling references, on their application, actually doing some due diligence on those references, making sure they have money in the bank, outside of just what it costs to buy a house. I mean, I can't tell you how many times, this year I helped clients lease, 5 or 6 properties, not something I do a lot of, but a couple times a year. Right. And the last one I leased, I can't tell, there was 3 guys looking to occupy one house. And between all of them, I think they had like $500 in savings. And the rent for the property was $4,600 or $4,800, somewhere in that ballpark. And I'm like, what are we talking about here, guys? Well, we get paid every month. And I'm like, yeah, you get paid every month, but where the hell's the money going? Like, so doing your due diligence up front and making sure that you've got qualified people to be there based on the things that I mentioned is your best, what am I looking for? The best measure against, somebody trying to squat in the property. But at the end of the day, there's no absolute 100 way to present it, at least here in California, because, once they're there, and it's a little difficult to get them out. So I'll end it with that. Josh, what is the most a buyer can buy down a rate? If a potential house seller feels locked in with If a potential house seller feels locked in with their low rate, why wouldn't they sell to realize their equity and just buy down the rate to the max?
So there's limitations. The discount points have to be considered bona fide discount points. We're not going to get into that. Every lender has their own legal department that determines what that is. So there is a limit to what you can buy it down. And to put it in context, like if I look at a rate sheet, I don't know if a lender would let you get away with it, but some of my lenders will show rates that would cost 10 points to buy down. So if you're going to take out a $500,000 loan, it'd be $50,000 to buy that down. So the answer is I can cash in my equity on this home, and then I'm going to give up $50,000 of it to get a lower rate. There's a cost to it. And that's what you're essentially prepaying the interest. You're paying it one way or the other. Points are prepaid interest that you are giving to the lender to make them forego a higher rate of interest over the long haul. So you're not saving yourself anything. You're not getting yourself any deal. The only way that would work out is if you stayed in that home and in that loan for more than 6, 7, 8 years to get to the break-even point. And the reality is we're going in the next 6, 7, 8 years, have an opportunity to refinance where you wouldn't have had to pay all of that. Maybe it's not down to 3%, maybe it's not down to 4%, but it's lower than where we are today. So paying the points isn't free money, and you are giving up your chunk of equity to get it. So it's not as simple as just moving around and buying the rate down to get out of your current home and into a new one.
All right, good stuff. Dina says, when looking for a house, do you communicate with just your agent typically, or do you consistent? Do you need to also update your lawyer and lender about every visit to another house? So the easy answer is no. You just need to communicate with your agent. Your agent is going through that process. The attorney and all of that and the lender aren't really involved until you actually go into escrow or until you're ready to make an offer on a property. Now, when you're ready to make an offer on a property, depending on how your agent approaches it, Andrew might do it differently than I do. Some people use a blanket pre-approval letter across the board on every property they write an offer on, and some, like myself, get a pre-approval package tailored to that specific property. Just so it's more professional in my opinion, in the environment that we're in. And so in that case, we would communicate with the lender, but the attorney, here in California, you don't deal with attorneys. Some states are attorney states, but they wouldn't really get involved until you're actually in escrow.
What I will say, Jeb, is for us, we check in about once a week with someone who is pre-approved and actively looking. Sometimes we pre-approve people. I had a call earlier this afternoon from someone who came from the show. They're not going to start actively looking till the end of January, first part of February. So we had that conversation. Not going to check in with them. Said, have a nice holidays. We'll get to you towards the end of January and just touch base and see where your thoughts are. But if someone says, hey, I'm out every weekend looking at houses, we're going to check in once a week to say, hey, you going to write any offers? Do you need an updated pre-approval letter? Here's what happened in the market. Here's how it impacts your qualifications. It's a 2 to 3 minute conversation. Sometimes the potential buyer doesn't pick up. We're just leaving them a message and letting them know that we're here. So you shouldn't have to proactively do anything unless you want information from your lender throughout that process.
All right. Good stuff on that one. Let's see here. I'm trying to include Andrew in this whole conversation, so he's not just standing there or sitting there staring at us.
I'm enjoying listening to you guys.
Let's see what we got here. I'm just looking through some of these. A lot of them are Josh questions, so I'm just going to keep hitting Josh up here. Josh, why does the FHFA raise the loan limit? Do they do it only when Democrats are in office? Do they do it when Republicans are in office? And I ask this because the question is, I didn't talk about the first part of it. It says, why is the Biden administration underwriting houses over $1 million? So if you guys aren't aware, FHFA now is doing high cost loans or high balance loans up to $1,089,000 on one unit. And so, Josh, why do they do that every year?
So 100% not political. It's written into the guidelines for the Federal Housing Finance Agency that they are going to look at their housing price index year over year. If it goes down, they do nothing. If it goes up, they increase that loan limit by a predetermined percentage. So the number that we came out with this year, no one sat down and said, you know what? I think 726,200 is the right number. High balance is set at 150% of whatever they set the annual limit at. And it is a predetermined calculation. So whether Trump's in office, Biden's in office, that number was going to be the same. Something else that's important, it drives me nuts. So last year was the first year that this is the first year that the loan amount is over $1 million. But last year we had a number that you could buy $1 million home with 10, 20% down and get a conforming high balance loan, quasi-insured by the government through Fannie or Freddie. And everyone loses their mind. Why are we underwriting $1 million loans? Well, maybe you guys don't realize, but for us in Southern California, first-time buyers are buying $850,000, $950,000 homes. They are not rich. So the flip side of that, the FHFA also has made some political decisions here. They decided that the rich that are getting those high balance loans shouldn't get this free ride. So they added this last year, a 1-point hit, a loan level price adjustment. So if you're getting a high balance loan and you're putting less than like 40% down, you're paying an extra point
because
to
you're
get
rich.
that loan. Because you're rich. And so you should pay that. And what did they do in the last couple of months? We're going to subsidize first-time home buyers, or I shouldn't say that, it's not a first-time homebuyer. They're going to subsidize low to moderate income buyers by eliminating loan level price adjustments. And I have no problem with helping and incentivizing low and moderate income buyers. But again, what is the definition? If you look at Orange County, it's like $80,000. Well, at $80,000, we've had people here on the show regularly. Hey, I make 6 figures. I live in Orange County. I can't buy a house. So that person deserves help to buy a home as much as the person in the Midwest who's making $40,000 a year, who actually can then qualify and get the benefit of this. So we have people in Washington, D.C. that are far removed from the reality of housing in our expensive urban areas, and we're leaving people out. We're charging and taxing the rich who aren't really rich, and we're subsidizing some people who need help and leaving other people out. I wish they would actually talk to people with boots on the ground. I mean, there's an answer. A salesperson always like, make it cheap for everyone. Make it great where we incentivize everyone. And we don't want that, because that's in effect what the government did for the last 2 years. We have home prices a little higher than they should have been based off of that. But there's a more just and fair way to do it. So answering this question, it's not political. There are some political things being done, and it's putting the thumb on the scale, and not equally for all people in low to moderate income levels.
All right. Well, there you go. There you go. Alan, quick answer here. Alan says, do my property taxes go up after I open a HELOC account? The easy answer is no. It's not. It has nothing to do with your property taxes getting a HELOC. So that's the easy answer there and the quick answer. Michael De La Torre has a couple questions here, Josh, pertaining to using his brother, and some questions here. But anyhow, says, can I use my prospective rental income from my brother paying me rent to qualify for a bigger house without putting him on title? He just got a new job in a different sector. So answer that question. Then he also goes on to ask a second part, similar question is there any downsides to having a cosigner parent on a loan?
For the most part, the answer to the first question, border income, you cannot use unless you've received it for the last 2 years and declared it on your taxes. There's some exceptions with Home Possible and Home Ready loans. So talk to a lender and go through your specific situation, see if that would be possible. The second part of that first question is he changed industries. That doesn't immediately mean that he couldn't co-sign with you or be a part of the borrowing. It doesn't make his income ineligible just because he changed industries. It might, but it doesn't necessarily do that. So talk to a lender where you are looking at buying. If you're in the state of California, I know one. If you're outside of the state of California, Jeb has lots of connections. Just fill out the form and we can get you connected to someone. You really want a lender to go through the specifics of that. On the second side of it, a parent co-borrowing for you. There's no downside to you. There's potential downsides to the co-borrower. The co-borrower has to get a 12-month history of you making the on-time payments before they can remove that from their debts when trying to qualify for a refinance or a purchase of their own. They are guaranteeing that you're going to make those payments. And if you don't, it is going to negatively impact their credit history. I had one a few years ago where a borrower with perfect credit co-signed for his sister with perfect credit, and her husband left her and she missed 3 payments. He wanted to refinance when rates were in that 3% range from his 4% loan. He was not able to do that because we had those late payments on his record. So there are potential downsides to the co-borrower, not really any downsides to you other than, potential downsides to that relationship if you don't follow through on your promises and make the payments on the timely manner and provide them evidence of that in case they need to borrow in the future.
Mama gonna whoop that butt. You don't
Exactly.
make that payment. Let's see here. There's a couple other ones. Actually, Willing is one of our creative commenters here on the channel. Willing, we have a question. How did you come across Josh on a different YouTube stream last night? So Josh does a VA veterans stream where it's basically all veterans on the stream, and they broadcast it to a YouTube channel, which essentially has very few viewers. If anything, a lot of it's on Facebook. But anyhow, Willing popped up on there. So just want to know how you found it.
Well, this is funny, Jeb. I think I may have the answer because I've never talked to Andrew. I've never watched one of Andrew's videos. I don't believe any of them ever showed up in my feed. When I went over here and pulled up YouTube to search for Ryan Serhant, what's in my top row of recommendations but Andrew's video about what if the market doesn't crash? So obviously Google's just listening. They know that Willing shows up here and they just say, hey, that weird Josh guy is over there. Maybe you should watch him on this too.
Perhaps, or maybe there's a more, a different answer. But there's actually a question here that they're asking as well, saying, what's the max? Well, we already asked the max concession thing, but is it based off the purchase price or is it the loan amount? 6% max on FHA, 369 on conventional, blah, blah, blah.
It's based off your purchase price, and those Willing gave us, and we discovered. So Andrew, you wouldn't know from Willing's name, male, female. We wondered for a long time. We assumed a man, but she outed herself as a female at one point. Works in the mortgage industry, and those numbers are correct. 6% of the purchase price on FHA, 3, 6, 9%, depending on how much you're putting down on a conventional loan. 4% on VA. VA has a weird exclusion that if you pay the closing cost, you can still get a 4% concession. So it gets a little bit more confusing, but you can't actually get more than 4%. And if it's investment property going to Fannie or Freddie, it's 2%. So there's really no difference between seller concessions and seller credits. Anything that the seller gives up as part of the contract technically is a credit and a concession. So a distinction without a difference.
Good stuff. Hanny has a question. Is it good to build a house or buy a house? So, Andrew, do you see a lot of potential homeowners building homes in your market, or are they buying like a tract home? They're not buying. Are they buying land and building a house, or is most of it existing?
It's not. Yeah. So that's a good question. So in Vegas, sometimes people think we got a ton of land because we're in the desert. I mean, I thought the same thing whenever I came out of San Diego to Vegas some 10 so years ago. That being said, you want a new construction in Vegas, 9 of 10 times, if not more, you're looking at tract homes. It's just what it is. We got every flavor of major home builder out here, a couple of local ones that are more high end, and some of your premier flagship regional luxury homes like Blue Heron and such. But that being said, most people don't build up from the dirt here in Vegas.
No, and rarely does it make sense, quite frankly,
so
to
expensive.
do that. Yeah, unless you have the cash to build it. I mean, getting a construction loan is one thing, but what you have to understand in the environment that you're in at the moment, with supply, constraints, delays on some of these things, how expensive it is to build at the moment, finding a good contractor, you're probably better off trying to find an existing home. You're probably going to pay less for an existing home than you are building in the current environment. Now, if the market slows down, these builders have nothing to do, prices pull back on materials and all of that stuff, then maybe it changes. But for the most part, unless you're looking for something super specific and you've got pockets full of cash, you're not going to spend the time and build a house. Typically, it doesn't make sense.
On that, there's two good things. I did want to throw out a plug to Homes for Our Troops. It's a charity organization based out of Massachusetts. I've worked with them now 3-4 times over the last few years. And what they do is they build specially adapted housing for severely disabled combat veterans. Very good cause, very good charity, Homes for Our Troops. You can Google them and check them out. But that being said, they, in that case, have given me a lot of experience of what it is for a person to go through the custom build process, since that's what they do. And in Vegas, a lot of our land doesn't have like septic and it doesn't have electric ran to it. And it's like easily 6 figures just to run all of that stuff into it and then start getting all the plans together. It gets expensive. So that goes to your point of just how expensive it is. I did some digging for a luxury client on some of those higher end builders and asked them what they build the property, how much it costs to build. And they would have minimum square foot requirements of like 4,000 square foot and $700 a square.
Oh, wow.
So, I mean, $700 a square might not sound like a lot to people depending on where you are in California, but in Vegas, I mean, that's like holy crap numbers, and minimum of 4,000 square feet. Do the math. I mean, those numbers add up fast. And I was like, well, does that include the dirt? And they're like, no, you got to pay for the dirt. So back to your point about how expensive that is versus a tract home. You think a tract home is expensive, try custom.
No, for For sure.
There's that piece of it, but when you go in and buy a home from an existing home from a seller, buy a new home from a builder, you have certainty. There's a fixed cost there. You have no certainty in terms of the timeline when you're building. So you're taking out a loan, unless, like Jeb said, you have cash. You're taking out a loan to finance it, and you're paying on that. You may not have to write the check every month, but it's getting added into your loan. So you're paying on that during the construction period, which usually runs longer than expected. So you have a lot more carrying costs. And then you also have cost overruns. So when people ask us this question, they're generally saying, hey, home prices are nuts. Can I save some money by building a house? And not generally the recipe for how it works out. I'm sure there's someone in our audience or out there that would tell us, hey, we did this and we saved 20% off the cost of going and buying a home. But for every one of those stories, you hear 10 or 15 of people with big cost overruns in time and money.
No, good stuff. Don has a question here. Don says FHA loan amounts are increasing in 2023. Right. The answer is yes. So what FHA does is they haven't released their numbers yet. They should be any day now, based on what I'm reading and watching and all of that. But they're typically 65% of the new conforming loan amount, which in this case is what, $726,200. So 65% of that is $472,30. So $472,030 is going to be the loan amount for low cost areas. And then the high cost areas should basically go up to whatever the I think the new conforming loan amounts are, right? $726,200 in high cost areas. And then obviously it goes up by units and all that good stuff.
Goes to high balance as well. They will do high balance loans. So FHA loans are going to be up in the millions too in Orange and LA County, the Bay Area, other areas like that. So Jeb, I would like to let Andrew in on one of your secrets to growing a successful and large YouTube audience.
What is that?
To have a dating element to your live streams. So what we do is we try to hook up viewers here so that they can mingle,
qualify for homes,
and co-borrow and qualify for homes. So Jay is asking where Dina is at, and Dina says, hey, I'm here. Are we going to buy a place or what? So it's important that in your live streams, you incorporate that element. We came up with that about 6 or 8 months ago when affordability reached new lows.
Well, yeah, when it was at its peak with regards to pricing, we're figuring out how can we get more people to qualify for homes? Well, we've got the solution here. If you're single, join our new online dating site where we pair you with other potential home buyers. And now you have dual incomes and can qualify for more home. Just makes sense. You don't even have to like each other. It's just something that we do because we care.
It's sort of like marrying for a green card. It's marrying to get a house.
Hey, listen, people do it all the time. So we're not against it. We will serve you if that's your thing. No, in all reality, appreciate you guys both being here. You're regular viewers of the channel, and we appreciate it. Josh, what do you say to somebody that's on a new build, not going to be finished until March or April, locking the loan now, waiting? Thoughts?
So for those of you who show up here every week, you probably get tired of me using this analogy, but we don't have a crystal ball. What technical analysis is the equivalent to counting cards in blackjack. It lets you know when the odds are in your favor and when they're against you. And sometimes you get a big green flag saying, hey, bet heavy, the odds are in our favor. Sometimes you get a big red flag like we had for the middle part of the year, which is we were saying just lock and get the hell out of the way because there's no signs of improvement on the horizon. I would say the odds of lower rates in the spring are very good. So with that, not really hesitating to float, but you would want to stay in contact with the builder's lender on a weekly basis. Where are rates? What are my options? What does a long-term rate cost? Some of the builder's lenders are subsidizing the cost of a long-term rate, which, if you go to a normal lender, they say, hey, a 6-month lock, you pay a point up front and the rate is 0.5% worse than a 30-day lock. So ask the builder's lender what the options are. I know in the spring, builder's lenders were saying, hey, lock with us. If rates get better, we'll float down, or we won't float down. But if rates get better, go get an outside lender. So if you're on the conservative side, you don't like the counting cards analogy, you don't think that you're comfortable with that, lock with the builder's lender, and you're free to use an outside lender in the future. Most of them are okay with that, and they know it's part of the game of being the builder's approved lender.
There you go. And it's not a game, guys. No, serious. Kim says, can you tell me when does your credit report update update each month? And is Credit Karma any good? So Josh, quick summary on that. And you can actually plug the home buyer podcast as well.
So the important episodes 38 and 39 of the podcast are live, where we did a really deep dive in credit. What goes into making your credit score was episode 1, so you can fully understand it. The second episode there, the second part of it was, how do you maximize it? What can you do to improve it in a short time frame? What are the things that will help you get a big score? So the quick and easy answer here, Kim, is that your credit score is a snapshot of a moment in time. I can pull your credit in the morning and it could be different than it is in the afternoon. What happens, the data inside of your credit report is updated constantly. So some creditors that you owe money will update once a month, some of them once a week, some of them update more frequently than that. And none of them are doing it on the same day. So, sometimes it's the 7th of the month, sometimes it's the 25th of the month. You don't really know. So as all of the information changes on a day-to-day basis, your score is going to change. And for the most part, Credit Karma is a very cheap model, not great, but it's as good as anything. It gives you a baseline so you can see, is my credit improving? Is my credit getting worse? What I would say is the lower your credit score is, 700 and lower from there, the further you get away from 700, the less accurate it is. We usually overstate your credit score by 20 to 30 points. Once you get above 700, it's generally still overstating it, but by just 3, 4, 5 points. So it's pretty good for those borrowers.
There you go. And the Knights says, looking to buy when our lease is up in 2023. When should we apply for pre-approval? You guys are just giving us the perfect opportunity to mention the podcast once again. On Tuesday, we answered this question directly when we talked about how to apply for a mortgage. The answer is it's never too soon. If you're thinking 2023, I would say beginning of the year, good time, go through that, have that conversation. It'll let you know if there's anything you need to work on. It'll let you know, hey, you're in the perfect position to do it now if you want it. It gives you security and or gives you things that you could possibly improve to put yourself in a better position. So I think the sooner you know, the better. But with that said, you don't need to be doing this 3-4 years out, right? It's having that initial conversation, like we mentioned in there, and then taking the next steps and doing whatever needs to be done. And if you need a link to a lender, check that link in the top of the chat there. Happy to refer you to somebody. There's also a link in the description to get you in touch with someone as well. Josh,
Jeb,
yes.
Sarah has a special request. She would like to be paired up with a doctor. She wants a nicer home.
Fantastic. What kind of doctor? Chiropractic doctor or like an anesthesiologist? Like, I need to know. We need to know.
Apparently, Dina is very attractive to Jays of all varieties. J, just the letter, and Jay Jays, because Jay Miller also is trying to talk to Dina. So I think we're really on to something here. We need to fully flesh this business idea out.
Well, YouTube started as a dating app in 2006.
I know,
look at what it is today. So who knows? You have the podcast, you have a podcast, you have this. So
I love this. I love how we start asking what the Instagram handles are. We need more pictures. Yeah, the little face picture's not working, guys. So we're getting closer. It's getting hot in here, Wesley says. Good.
I believe the dating app was actually Wesley's idea. He will get a royalty when we kick it off because it was Wesley's idea about 3, 4, 5, 6 months ago.
That's so good. Let's see. Marcelino, this question was early in the video, probably long gone at this point, but we'll answer it anyway. What do you do if there are very few comparable homes in an area? What makes it more appealing? I'm not sure what the first part of that question answer or was asking, but what do you do? I guess, Andrew, 2 things. If you have a buyer looking to buy a property, and they're, again, one of those people that says, hey, listen, I think that home's overpriced, but there's no comparable homes in that area to compare it to. What do you do? And or the other side, you got somebody that wants to sell a property, nothing really comparable. What are you telling a seller in that situation?
Well, there's two separate questions, questions, but a very similar answer. So I actually know some appraisals. Obviously, you want to know some appraisers on the side and everything. And what I'll do is with an appraiser that, of course, needs to be remunerated for their services, I'll actually call them in. Because I've had to do that before on the listing side where I know the seller's telling me something that's not jiving with square foot. Well, the only way to get that updated is to have an appraiser report done so that it can get updated officially through the records. Because obviously, if you're off in that case of that property, 700 square foot, that is a substantial chunk of money, even if you were just going easy math, $100 a square there.
Right.
As far as a buying standpoint, then you can actually write it into your offer. Hey, property to be appraised. If everything checks out, seller pays for it up front. And on the backside, if everything checks out, then the buyer takes on the cost. I mean, it's one of the easiest negotiation things that I've been able to find based upon trying to find the value if the seller is of a mind to sell the property and the buyers and of a mind to pay fair market for the property.
No, good stuff. Here in Southern California, where I'm located, you don't really have these situations, right? I mean, there's something to base it off of. I don't know how I would address that in markets where you have rural properties, like where I'm from, Eastern North Carolina. I mean, you can go, a quarter mile and there's houses apart from each other. And, you might only have so many houses within, a certain radius. So it's a lot more difficult. So that's a difficult question for you to answer directly, but Andrew's way sounds as good as any. So
I learned the be fair. I don't remember her name off the top of my head, but it was somebody that had taught me that when I was first getting started, and I'd asked for some of the semi-custom and custom properties. How do they value those properties in Vegas, since there is no track home comps, if you will? And that's what she had taught me, and it's just have always stuck with me. That was a really good way to approach it.
No, I like it. Josh, if you lock a HELOC at the current rate, let's just say it's not even a HELOC. If you lock a rate at the current rate, but the rate goes down in a couple of weeks or even years, can you reduce it?
So let's answer her question, because the HELOC is unique. HELOCs, banks, credit unions make them, and they make up their own guidelines for them. So we're not talking about an FHA, VA, Fannie Mae, Freddie Mac, where everyone underwrites to the same guidelines. Not all lenders offer that lock-in option. And I'm sure some that do offer a float down, but most of them don't, because what they're saying is, the HELOC, home equity line of credit, you can borrow against it, pay it down. It's a variable rate. Whatever you've borrowed, you're going to pay the rate at the current time. What they will do with the lock is, let's again, $100,000 HELOC, you've borrowed $20,000. You can say, I will lock that portion because I've already borrowed it and I want to know what my repayment's going to be. And they're willing to do that because they say, hey, in today's terms, this is the fixed rate that we require for it. So I'm sure there are some that will let you unlock it and go back to a variable or float it down to a lower rate. It wouldn't be the most common option there. But Jeb, this is like a jackpot over here. It's like we have a slot machine popping up that everyone is trying to give their $9.99 monthly subscription for the dating app. I believe you and I are really in the money.
Take this and go buy Elon's blue check mark on Twitter. Yeah, Jay commented, he found me on Twitter. I don't do much on Twitter other than read news. But he found me on there and basically gave me crap for not having the blue check mark. So he wants me to pay $8. What the last I read, I think that's on hold until they figure out another measure to make it more difficult, I guess, to actually confirm you to confirm you are who you say you are. But appreciate the super chat on that. Ivy, $10 super chat. Thank you again. Is that a second one? Is this
the
two?
Second one? She doubled it up.
Was that an accident? Either way, we appreciate you. If it's an accident, let me know. I'll Venmo you back. I won't make you pay it.
If you change your mind at the end of the show, ask for there's a 24-hour window for refunds.
Yeah. And then Jay Miller says, you in SoCal. I'm not sure if he's talking to me or Dina. But I'm in SoCal. Jay, and Andrew's in Vegas. Josh is in SoCal. Dina is in like a state on the East Coast somewhere. I forget where. Florida, maybe? Florida?
Geographically undesirable is what I'm hearing.
Geographically undesirable.
She's in New York.
Oh, there you go. Well, then you could benefit from our Ryan Serhant call if you're looking for luxury real estate. So we'll see if we can make that happen. I mean, there's so many, like a lot of these are, Josh, me and my partner, or Andrew, whoever wants to answer, me and my partner are looking to buy our first investment property in Bakersfield, California. So Central California. We are currently in the process of saving our 20% and can possibly have that in about 6 months. Should we wait longer? So Josh, what's the difference in 20% versus 25%? And even if say you had the money today, is it beneficial to wait? Or should you buy now?
So let's look at this.
It's an investment.
We've answered this question differently at different points in time, right? So 2020 and 21, we're like, as soon as you have enough to meet the minimum down requirement, you buy, because prices are going to go up and we didn't know how long rates were going to hold. We're in a very different market right now. already said we think that rates are going to trend down. We don't see a lot of pricing pressure upwards. So if you're looking at getting to the 20%, if you're buying an investment property with less than 20% down, if it's a single family residence with Fannie Mae and Freddie Mac, you can do it with 15% down. You're going to have really expensive mortgage insurance with it. You're going to pay a premium interest rate. So since rates are already high, home prices are high, you're trying to make that thing cash flow. It's pretty important that you get to 20% down on that. So I would say go ahead and wait. Expedite your saving and see how quickly you can get there. But there's not a lot of urgency to get it done, because I don't see a whole heck of a lot changing in the next 6 months when you think you can hit your 20% level.
No, but as far as buying, like if you had the money today, should you wait? It's an investment property. So the numbers either make sense or they don't. And if they make sense and you think, you're comfortable with those numbers, then sure, pull the trigger. If you think by waiting prices are going to go down, and rents are going to stay the same or even possibly go up and you're going to get more, then you got to do what's right for you. It's for most people, it's never going to be the perfect time to buy a property, whether it's a primary home or whatever. But I can tell you, from an investment standpoint, it's less emotional and should be more about whether or not it cash flows, or maybe you're not even looking for cash flow. Maybe you're looking for appreciation and less cash flow. Whatever it is, it's less emotional, and you should think about it more logically. So hopefully helpful with that comment there. Any thoughts on buying older homes versus newer homes, Andrew?
Well, it depends on what someone's looking for, but typically in Vegas, at least, I would normally suggest keeping it within like a 20 to 30 year age frame, ideally. And that just has a lot to do with the history of Vegas and the history of what has happened in the market, where you saw in Vegas, at least when the market did collapse, I was still active duty. But having come out here and get licensed thereafter, I saw a lot of homes that got trashed. So depending on the age of the home, you never know quite what handyman special you may be walking into, and what flipper may or may not have done something good. So typically you want to have a very solid home inspection, but it really comes down to, is the property in the location that you want? Is it in the price point that you want? And is it something that you feel comfortable with for your lifestyle? And then the rest of it falls into place from there. But typically I would say the newer-ish, maybe again, 20, 30 year window, the better. And that has a lot to do, honestly, with like how long things last in a house, the roof, the AC, those type of big ticket things that you guys start replacing.
It's funny hearing people from newer cities like Southern California, Las Vegas, thinking in terms of 20 and 30 years being old homes. What do you say to our friends in New England who watch Farmhouse Fixer with the new kids on the block, and they're renovating homes that were built in 1780 and 1820? You guys have any thoughts on that? It obviously can be done, but it changes the calculus on it, where for us, a 50-year-old home is an old home. Some of these areas have 100, 150-year-old houses.
Yeah, I don't really have the knowledge of it. I mean, I'll tell you, I'm from an area, like I said, in Eastern North Carolina, where homes are a lot older, right? I mean, my family, my cousin owns a house now that's been passed down through generations. At this point, I mean, it was built in 17, I forget, maybe early 1800s. But either ways, it was built with like pegs and no nails. I mean, the boards are pegs and whatever. And so, they're doing remodeling on this house, and I mean, you're on the second floor, and at one point they opened up, walls and made great rooms or whatever. And they jacked up, the ceiling to do it because, at one point a big oak tree had fallen on the house and whatever. But you go upstairs and the floor is not level at all. I mean, it's like you're walking all over the place. So with older homes, there's definitely an opportunity to have way more issues than with newer construction. But at the end of the day, it all depends on what you're looking for, right? I mean, he my cousin always jokes, like we went to some friend's house in Raleigh for a barbecue while we were there, and he was joking on the house before we got there, because where he lives on, I don't know how many acres, like tens of whatever of acres, and the nearest neighbors, like I mentioned, like a quarter mile away. And as we were going to Raleigh, he was like, you can't even squeeze between the neighbors' houses. And we get there and the houses are like, 50 yards apart. Like, I mean, that's his, like, he'd rather be in the country than in more in the city, metropolitan type areas. So it all depends on what you're looking for.
That's funny though, with 50-yard setbacks between houses, and that's cramped. Where in Vegas, we have some zero lot lines. We're not, before we get into row homes, and that minimum setback is 5 feet.
Yeah,
so
no, here it's like 6. I mean, between each house and a wall. So, there's like 12 feet between walls, but roof lines are probably closer than that. Some of these things you could jump from roof to roof on, if you were, like playing a video game. Josh, what do you see there that you want to tackle?
Well, we have a couple of viewers here who confirmed what we were saying. Aware24 says, my home in OC is 65. I remodeled it and it feels modernish. My home was built in 72. Same thing.
I'm 73. Yeah.
So about that same timeline. So they can absolutely feel really nice. I almost feel better about homes of that 60s and early 70s vintage. Once you get into the 80s and 90s, it's a little more questionable depending on who the builder was. And then we have the other side of the country, Rhode Island, the smallest state, literally says many homes here in Newport, Rhode Island, built in the mid 1600s to 1900. So it's all relative. My 60-year-old home is new compared to 50-year-old home is new compared to 300-year-old home.
No, good stuff there. Hey, Mari, just welcome. I know you're late to the show here, but you got some guys already reaching out to you.
Put your super chat in. You don't get connections. You don't get.
Yeah, you're probably unaware of the dating site that we have going here, where we connect people on this to help them buy a home. But that's what you've walked into. Let's see. Marcelino, another question. Like I mentioned earlier, I travel frequently between cities in Texas, fully remote. Would it be difficult to finance as a primary residence, even though I spend majority of my time traveling? So Josh, when you have somebody that travels a lot for work, how do you determine where they're eligible to purchase a primary home?
So think about this. We never ask, do you travel? If you're buying a home in Dallas and your employer is in Fort Worth, no problem. 20, 30-minute commute, totally normal. If they're in San Antonio or a little further away and they're going to start asking, do you commute? Do you work remotely? So your worst case scenario is just a verification of employment where your employer comments on your work situation. Why are you able to live in that city? So if you are constantly traveling for work throughout the state of Texas, but at certain points in time you are at home. Home can be anywhere in the state of Texas that you would like. It just has to make sense. They're not going to take into account the fact that you travel a lot for work.
There you go. Hopefully that helps. What are we doing? What are we doing here?
Well, I want to see if either one of you guys have any thoughts on this. Alvin says he's got 4 properties, bought them for $38,000 each. Must be somewhere in the Midwest or another locale with lower
Detroit
prices. But what do you guys think of Section 8 people to rent to? Pros and cons.
Pro is it's a guaranteed rental amount. Typically speaking, I don't know a lot about Section 8 just because I don't have any clients that have Section 8 housing. And there's here in Orange County where we are, at least here in Huntington Beach, there's very little of it, at least that I've come across. So I don't really, honestly, I don't have a lot to really put forth on that topic. Andrew, you?
No, not at all. I don't even get in the mix of rental properties.
Okay, there you go.
We have a viewer of the show who we helped at the far end of the window when rates were increasing, that refied 3 rental properties with us. And her belief was you only rent to Section 8 tenants because it's subsidized. So at least a portion of the rent is coming directly from the government every month. And to stay on the good side of the government and make sure they don't get kicked out of the Section 8 program, your tenants have to be good tenants. They have to pay their portion on time. They have to not beat up your property. So they tend to stay for a while. You tend to get your payments on time. They tend to take good care of your property. Remember, Section 8 is for low income tenants. It's not for bad people. It's not for criminals. It's for folks who are on the lower end of the income spectrum. So there's a little bit more screening there. You actually have a third party kind of validating and holding them accountable as well. So that is a third party perspective from that client. But I've also talked to other clients who do have a lot of rentals that they rent to Section 8. And most of them have a very positive experience and a lot good to say about it.
All right. Andrew, I'm going to throw this question your way here. I'm going to kind of reframe it a little bit, but it says, I'm close to a close date on my new build, which was supposed to close 2 months ago. Based on increase in interest rates, should I ask my builder for a lower price on the home? So in your market, some new construction out there, have you come across an opportunity where somebody was already under contract in a new construction property that wasn't finished and has been able to renegotiate? Do you think there's an opportunity there?
Well, you never know until you try.
Right.
So in this case and in the situation with that fluidity in the market, I would definitely go for it.
No, I agree as well.
I would straight up go for it.
Yeah. I mean, if you're in a market, I mean, here's the thing. Here's the caveat. If you're in a neighborhood where there's no available property to sell, and they're nearing the end of their project, or maybe all the homes are built and they're just finishing some things and whatever else, probably going to be a little bit more difficult. But if you're in a neighborhood where they're in, the first phase or whatever, and they've got a ton of homes just sitting, and that if you don't buy, there's probably not a buyer lined up behind you, it's definitely an opportunity to try to renegotiate. I mean, like Andrew said, the worst thing that can happen is what? They say no, and then you can make a decision whether or not you want to move forward. I mean, hell, Josh, go ahead.
No, I was going to say, and I was going to ask you for the validation in your marketplace, but a lot of the new home build contracts I see here in Vegas is they'll actually have, to that first point of how they'll try to get you, is they'll have within that contracts find terms that they have up to 24 months to build the property, given any type of supply chain issues, mother nature issues, economic issues, acts of what they call it, acts of God. So, they have like every way out, but that doesn't mean that given what's happening in the market, that they may not become more negotiable, and also be looking to try to get some goodwill going, because they do have so much inventory, standing inventory, especially ready right now. Because what's to keep you from backing out and then trying to recall your money, depending on how much money you got into it. If you got too much money into it at the design studio, you're not going to get that back. You're not going to get your EMD back, but it just depends on how big of a difference you're talking about. But I would go for it. My gut says go for it. Ask the builder, see what happens.
Yeah, no, I agree with that 100%. I mean, where I was going to go with the comment here after that was, Josh, this week you've had somebody that, how close were they to closing escrow?
2
They backed out.
weeks. It was a 45-day escrow, so 2 weeks, 30 days into it, and backed out and walked away from a $38,000 deposit. Didn't even fight the seller for it, which they had given up and released all of their contingencies, so they wouldn't have had much of a leg to stand on.
And what was the purchase price on that property?
$1.3 million.
1.3 million, $38,000, and they just said, screw it. We're not moving forward for one reason or another. Now, the reason was family reasons and something else, or just like they didn't feel like it was right. They thought the market. Yeah.
Vague family reasons. They said, we feel like the market might be turning, which anything's possible. Where they were buying, it did very well in the last downturn, good school districts, everything good about it. But you got to be comfortable. And they were very well qualified, perfect credit, excellent income, lots of money in reserve. So it wasn't a marginal buyer just getting spooked. And it wasn't an irrational person, smart man. It was odd, but it's happening in the current market. Like that a year ago, no buyer would back away from a transaction and give up a deposit because they'd be worried about ever getting another property under contract.
No, agreed. And here's another situation here in our market, Josh, is that there was a home in my neighborhood that was listed for $1,050,000. It was a smaller property, 3-bedroom, two bath, like 1,300 square foot. It sold for $1,050,000 within a couple of days on the market. Buyer went into escrow, and then my understanding, what happened was a buddy of mine was a listing agent, but I saw it close, and then I saw it come back on the market the same day, and it came on the market for $100,000 more. It was listed at $1,150,000. And I go, dude, what happened there? He goes, crazy story. They got into the process, already released their contingencies, and decided, you know what? We don't like this property. We want a different property. This property needs way too much work. We actually decided we actually need a little bit larger floor plan. This isn't going to work for what we need. But they decided to close on it anyway through another agent. And I was talking to my wife and some other people after this, and I go, it would have been better had that buyer just walked away from the deposit at that point, because let's just say it was 3%. That would have been $33,000 roughly, a little bit less than 33 grand, versus try to price it $100,000 more than the market, which you're not going to get in this environment. You're not going to get what you paid for it at $1,050,000, because quite frankly, in my opinion, it's probably more than it should have been based on the work that needed. So you would have been better just taking the loss at 33 grand, because if you sell it at what you paid for it at $1,050,000, if you just factor in, hey, the agent's going to do me a favor, a buddy favor, because she just sold it and it's not going to charge it, and we just get it, say 2%, just 2% to the buyer's agent. Maybe you have to close some closing fees or whatever, say 3% total. You're already at the same price. So you should just walk away now versus getting into that process. So I can see in some situations where it makes sense to do it. but that's not normal. So just, have a professional on your side, just putting some, the right things in your head so you can make the right decisions if you're in that situation. Let's see here. So 6:48 in at the moment. For those of you that don't know, Mr. Andrew Finney is our guest tonight. He's an expert in the Las Vegas real estate market, surrounding metro market there in Vegas. Has a YouTube channel with a big following. So if you're not following Andrew already, go check him out on YouTube. It's his name, Andrew Finney, Finney. His contact information is in the body of this episode. You can actually click on it and find it. And if you're listening to it on the podcast, it's in the description there as well, where you can find him if you'd like to contact him and have any questions. You want to harass him online. Maybe you want to date Andrew and be.
I'll send my $9.99 if something works out.
You have to do it through our app, and we get our $9.99.
Yeah,
and
you'll see on the next one at $9.99.
We'll hook you
know
up.
What happened?
That's everything that's happening here. But just want to make sure I plug that before I forget. So, Josh,
thank you.
What are we doing here? It's 10 minutes left to go ish. Anything we want to talk about? Any questions we want to answer before we head out?
I think we covered everything, for those of you that are here and showing up every week and participating in the dating,
read some of this
and
stuff.
giving us super chats. We're having too much fun. So we need to be more serious going forward.
No, I do. I really appreciate it. Andrew. I don't know, you probably never watch our live. I wouldn't watch it, quite frankly, but
I did watch a portion of the one that you sent to me to let me
just
know,
to give you an idea of what you were getting into.
I thought it was cool.
Well, I appreciate it. But a lot of these people show up every week, man. And a lot of them have bought property and aren't even in the market at the moment, which is a testament to the support that they're providing. And I am grateful for that. I'm grateful for you being here and spending nearly 2 hours with us. Grateful for Josh doing what he does every week. So, it's after Thanksgiving, but I'm still grateful for all you people.
I'm grateful.
And you too, Wesley. Yes, I'm talking about you as well.
And Wesley and Jay and Dina. And I just like what I'm thinking here when you threw Dina's comment up here. She says, thank you, Andrew. Like she heard that Andrew was going to jump into the app and she said, forget Jay and Jay. I would like to connect with Andrew.
Yeah, we already know. But here's a really good question. This is something Josh and I were talking about today. What do you guys actually want to hear from Josh and I? Not on this, on the podcast, in video. Like, obviously, if you watch my content, you see a lot of the same stuff over and over again, right? Because the housing market doesn't change as much as I post. So I try to provide some updates on what's going on in the overall market, and then some stuff that's educational, a little bit more directly related to different pieces of real estate. Maybe it's buying, maybe it's FHA loans, maybe it's things to watch out for in a mortgage, whatever it is. But what do you guys actually want to hear from? I mean, Andrew could benefit from this too. He could take this and run with it and do some videos on it. We like to provide educational content, but we also like to provide stuff that you're interested in watching, and or listening to. So if you're inclined, please list below what you'd like to see more of, because it helps all of us in creating the stuff that is, what you want to see. So, but Josh, I think this is the point in the show where we're going to head out. I'm going to ask you once again to hit the thumbs up if you haven't done so already. If you like troops, if you want to support veterans, hit the thumb. That's probably not the right way to do this, but Andrew's a veteran. Thank you for being here. If you found any value tonight, hit the thumbs up. If you liked Andrew, hit the thumbs up. If you dislike me, hit the thumbs up. Do you think
whatever happens, hit the thumbs up?
Yeah.
By all means, get the algorithm love, hit the thumbs up, drop some more comments, and rewatch this again after it's posted.
Yeah, and listen to it on the podcast. But again, go check out Andrew's channel. I'll leave it to you, Andrew, you, Josh, to head us out.
Well, I was just happy that Willing pointed out, Andrew, you may not know, but Dr. Ben Carson is still alive. I had him killed off, and Willing just reminded that Dr. Ben approves of the show. So we'll leave it at that. I'm going to give Andrew the last word.
Oh, okay. Well, thank you, gentlemen. And lastly, again, Jeb, Josh, thank you so much for having me on your show. To everyone that joined in the live stream, thank you. You're getting some amazing content, amazing information here. And I just really appreciate the opportunity to join you guys. And if you guys ever want to collab on my channel or back over here or whatever, I'm always here to help. And I hope that everybody does well. And I hope that how do I always normally like to say it? I'm going to send you the positive vibes that everything goes your way. Always.
I like it. And with that saying, guys, we're going to say adios. See you next week.